It's always a pleasure joining this event every year. I think this is the third or fourth year we've been at the SOSV since the COVID times. And it's always great to discuss some of the most critical challenges of these times. Every year it's been different. This year it's definitely about the first of a kind and the big valley of death between funding these companies, the early stage technology and the later stage. We thought, what better way to address those questions than bring three generations of entrepreneurs in our own portfolio. We've been investing in climate tech, clean tech 1.0, climate 2.0, everything in between for the last 20 years. I personally have been investing in this area for 17 years. We are an $18 billion assets under management. Every time we raise a fund, every 2.5 years, we have a seed fund, a main fund, and later stage fund. So we have invested in these entrepreneurs over the seed stage, over the main fund, as well as the later stage fund, across check sizes anywhere from $2 to $50 million kind of numbers. So delighted to be welcoming some of the top entrepreneurs who have gone through the FOAK stage or going through the FOAK stage right now. But just to define it a little bit, Climate 1.0 is more about solar, wind, batteries. A massive scale has been achieved on some of those segments. Climate 2.0 was more fusion, geothermal, which is all getting a lot of traction, even in this current administration, given the data center push, and you need 24/7 baseload power. But there are a lot of other areas like steel, cement, hydrogen that are certainly emerging and getting traction in the first of a kind plants. Capital availability has certainly been a challenge in this market for some industries and not so for others. The journey between the two waves has certainly been tough. Jumping quickly into FOAK, it's becoming a critical piece for any climate tech journey, and scaling globally is even more challenging. But thinking about global expansion is a critical one, given some countries have bias towards certain industries within the climate, and other countries have in other areas. As Ryan calls it, there is a tech FOAK that needs to happen, and there is a commercial FOAK. We'll talk about that concept a little bit. But let me quickly introduce the three folks we have in the room. Jennifer, your tech is now integrated in facilities across the world, in China, in India, in Belgium. You're selling the lowest carbon ethanol that can be used for markets like SAFs and potentially marine fuels. You have done both technical and business innovations to get the products to market. Glad to have you here, telling us, sharing your words of wisdom with the team. Jumping on to Ryan. Ryan, you have integrated your tech into a technical FOAK plant and now on the path to building many more. So glad to have you as the kind of what I call as the second generation of FOAK builder in this industry. Laureen, CEO of Hertha Metals, you have just de-risked your tech with less than $15 to $18 million of funding, while other people have had to raise hundreds to get to the same point in a year from now. And you're on your way to building a FOAK plant. So this is the right set of people to bring up words of wisdom as well as bring up key questions. Without further ado, let me just ask you to define, summarize what your company does in a minute or so before I jump to each of you and have you walk us through the journey. Jennifer, could you start? Just a quick introduction.
Absolutely. So what LanzaTech does is it converts waste carbon in all of its form, industrial waste like steel mill gases, municipal solid waste, agri-residues, all the way to SAF. And we do that by basically using a bacteria and recycling carbon emissions.
Thanks, Jennifer. Ryan?
Yeah, so Ryan Gilliam. So at Fortera, we're focused on paving the way to zero CO2 cement, and really the way we're doing this is same way, frankly, how the building blocks of nature come about. So we capture CO2 and make a reactive form of carbonates that can be used both as a partial cement replacement or as a standalone cement. Same way coral reefs and shells form in nature. And I think the big thing, and we'll get into this when we get into the FOAK, but really our focus is partnering with cement and lime companies and leveraging what they do well to drive down costs, to make it economic and not require green premium to get the product to market.
Thanks, Ryan. Lori?
Hertha Metals, we are a tech-enabled steel production company. We partner with incumbents similar to Ryan at Fortera, and steel, which is the backbone to industry and society, and also the structure behind all the data centers going up, has been made the same way since 1850. Hertha Metals has developed a better way and demonstrated the world's largest single-step ore to steelmaking technology that first and foremost reduces cost significantly and emissions.
Thank you. That's very helpful. I'm going to do the panel slightly differently compared to usual. I'm not going to ask each of you a question and go round robin. Each of you have a unique set of learnings experience, and I want to distill that in one comprehensive conversation. So I'll start with Jennifer. Really walk through the FOAK, how you survived, how you went to FOAK, how did you scale, what is the capital stack innovation you have done, what kind of partnership models have you explored, what was your de-risking path, strategic focus, and so on. That way, everybody can get a good sense for an end-to-end story for one company. We'll kind of repeat that for Ryan as well as Laureen. Each of the visitors in this room will have a different takeaway depending on where you are in your journey, but it's helpful to distill it all in one place. Jennifer, I'll start with you. You've been the most senior serial entrepreneur for us, and glad to have you here. So let's talk with the survival story for LanzaTech. FOAK for you happened a decade ago through the Grand Canyon of death in the clean tech journey. What kept LanzaTech alive through those cycles?
Yeah, that's a great question, but I think a lot of it is patience, right? It's a realization that to build the first of a kind of a completely disruptive technology, something has never been done before, and something people said couldn't be done. Everybody told us gas fermentation cannot scale. Other people have tried it. So it's about patience and it's about persistence. At the end of the day, you have to learn not to take no for an answer and just keep plowing. So that's part of it. And I think the other part of it is really thinking about partnerships and strategic partnerships. We have worked with partners in the steel sector, in the refining sector. And so these partnerships are very important. And how do you structure them to ensure success is also really important, because a lot of people who are trying to build first of a kind focus on technology, but it's technology, it's the business model, it's the collaboration model, it's how you protect IP while still being able to get to scale. So there's a lot of moving parts, but it comes down to partnerships and persistence.
That's a critical point, because I do hear a lot of startups starting with the intent of, hey, we'll build the technology, we'll license the technology because that's a way to scale faster. The issue always comes down to, you may create a value for somebody, but you cannot capture the value if you do it the wrong way. So the partnerships is a critical, but how do you structure it as an early stage company versus as you mature through later stage company? How do you expand the value capture? All of that becomes very, very critical. And we'll peel on some of that stuff. So thanks for kicking it off. Your tech is being operated in China, in real plants in China. You have a plant upcoming in India. There is a plant operating in Belgium. What does scaling biology in steel mills mean? And what does it teach people in terms of how do you scale some of these technologies?
Yeah, actually, that's a really great question, because one of the things that you have to really think about is that we are doing something that they've never thought of before. And getting into a refinery or into a steel mill, they're in a production mindset, right? They cannot afford to have anything that will disrupt their production. And so something that could have an impact on carbon intensity, something that could help them, sometimes is a distraction. So I think the most important thing to do is, one, to show how you're not going to disrupt them, that there is nothing that will happen at your plant that will impact their plant. And then the other thing you have to do is make sure that you show them a true value proposition, because they really also need that massive motivation. So that is what we focused on. And everybody always says, why China? When we went to China, the reason I did that is because China had 50%, manufactures 50% of the world's steel, and China was always in growth mode. When you go to industry that's in receding mode or in yield optimization mode, they're about reducing costs. They're about doing less. Whereas if you go to an industry or a group or a geography that is in growth mode, they want to embrace new things. They're always thinking about new things. They don't sit around the table talking about how can they reduce 5 people or $10. They think about how can they create. And so that's why China was a great opportunity. They were in growth and creation mode. And again, it was 50% of the market. So, when you don't have a lot of people, you want to go to where everybody is.
Yeah. And since then, that China, those 4 factories were many, many years ago. Since then, all your focus has been on Europe, India, US in terms of building these plants? And maybe just to give a flavor, you mentioned the steel plants, and there's a critical point that I want to bring up in terms of how you thought about integrating into existing facilities. And that's a critical element we'll discuss with Ryan as well. The cost for any next generation technology, whether it's in climate or semiconductors, whatever, it is always going to be expensive. So the more any of us integrate with existing facilities, the less barrier for us to get adopted and the cost curves to go down. Maybe explain, Jennifer, a little bit on what does LanzaTech do? Why are you integrating with steel mill? Why not purchase CO2 or CO to make carbon dioxide or carbon monoxide to make ethanol? And then that gets converted into the SAF that you're focused on. Why integrate with the steel mill? Why is that a critical piece?
Well, I mean, in our case, at the end of the day, it's about reducing the size of your supply chain, and moving gases around or moving waste around just makes no sense. These are inhomogeneous resources, right? So you can't really move them around. So we actually go to where the gas is, and that is why we integrate in a steel mill. It's really about a cost reduction exercise, right? The shorter the pipe, the shorter the distance everything moves, the better it is. But I also think people also need to think about integrating. When you do a first of a kind, at the end of the day, you said something really important. You said first of a kind is expensive. Yes, you put a lot of belts and suspenders. And if you do it in a greenfield location where there is no infrastructure, you have to pay for putting in, the electricity junctions. If you go to an industrial site and you integrate into an industrial site, you get a lot of benefits from integration. You can use their wastewater plant, you can use their electricity, you can do all those things. So it's both the logistics and supply chain of not moving things around too far, but it's also about integration and reducing costs. You leverage a lot of their infrastructure. You don't have to build a control room. They've got one. You pipe right in. Things like that really reduce your capital. Then when you de-risk your technology, you can go greenfield, because then you know how to reduce the cost
Sure.
without having to always be integrated.
Got it. Coming back to the cost question, because we have this concept within Khosla Ventures of investing in technologies that can meet a Chindia price. Our technology should be able to accomplish the cost economics of selling these products in China and India as a proxy for saying you have to be cost competitive, not just depend on subsidies. Ethanol plants from your technology are already profitable in China, and you can sell that ethanol to make the SAF, which is part of your technology as well. Now, your overall cost structure at scale would provide the lowest carbon ethanol and SAF, and even potentially for marine fuels. Tell us how important that is versus depending on subsidies to get through the product in the market.
Yeah, I think that's a critical question. And I think you cannot always depend on subsidies. I think there's no issue in having subsidies initially, because when you're building the first of a kind, you get yourself into a mode where you need a little help, right? Because your CapEx is higher, as you said, right? But at the end of the day, you need to get to yourself to a place where you're competitive with the incumbents. That is super important. And there's a couple of reasons for that. One of which is that people don't want to bet on subsidies being around forever, right? Governments change their mind, different jurisdictions. So you really can't depend on others. So you have to work to reduce your costs. And this is why things like integration matters. I've heard people say, oh, well, I'm not really worried. That extra pump is only $2 million. Yeah, but installed costs of that $2 million pump is $20 million, right? So how many of these kinds of little things that seem small can you afford? So it is about looking at everything. And then the last thing I would say is, in going to India, China, and other locations, you have to think like you are in that jurisdiction. Don't wear your Europe lens or your US lens. Does the plant have to have the most expensive rotary pump? Or can you have something a little bit less sophisticated that's a lot cheaper, and then you can serve a jurisdiction that is much more CapEx sensitive? So there are trade-offs that you make even on the choice of equipment. You need to remember you're not going to take a $200 million European plant and put it in China because they want that plant to be $50 million.
Yeah, no, it's very helpful. shifting gears a little bit, Jennifer, you were looking at a lot of end markets for LanzaTech, from biofuels to carbon to textiles to ethanol for SAF and all that stuff. Tell us a little bit about your journey on why it is important for a startup to look at multiple markets in the initial years, but quickly narrow it down to the market that has the highest impact, highest potential, where you have the highest competitiveness. How did you narrow it down to where you are today?
Well, I think really it's by at the beginning we threw a lot of things at the wall, I think is what you're saying, Rajesh. And for example, we developed ethanol to sustainable aviation fuel technology when everybody thought that was nuts. Why would you convert ethanol, a fuel, into another fuel? Why is SAF important? And yet we did it. And now when you look at it, that is a mandated market, a mandated global market is a great market to go to, right? Because there is massive demand. Fuel markets have massive demand. But at the beginning, we just had to try a few things. And to be honest, part of the reason we had to try a few things like polyester, for example, like materials, is because we leveraged the voluntary markets, the brands that wanted to do something with their scope 3 emissions, for example. That was important at the beginning because we did something completely new. There was no legislation in fuels that actually allowed us to have a seat at the table. We're a recycled carbon fuel. At the time, everybody wanted something from corn or sugar or cellulose, and we were instead doing something recycling carbon at an industrial site, which was not part of the legislation. So you have to be really careful because sometimes legislation, if you're doing something disruptive, is not there with you. So throwing things at the wall allows you to develop pieces of industry until the day when things catch up with you. And then you can say, oh yeah, that is the biggest market. Let's focus on that one.
Super. Jennifer, I could spend hours with you, but we'll go through Ryan and Lorraine and come back to you on some of the takeaways as well. Ryan, you're building the first of a kind in cement plant, fully decarbonized. Tell us the neatness of your idea, because there are a lot of other ideas on this happened during the 21 to 24, where many of us are material scientists, like think about new materials for a lot of markets. And there is always a fanciness towards, can we come up with a new material to solve a big problem? Why did you not think of a new material to solve the cement problem? Why did you think about integrating with the existing cement plant? What is the beauty in the idea?
It's a good question. I mean, frankly, it has a lot of parallels with what Jennifer has talked about from going from Climatech 1.0 to Climatech 2.0. I think and you know this from our conversation, I think we formed a pretty hardened thesis over these last 17, 18 years of at least myself being in Climatech. And the challenge with cement, and I'm sure the same with steel and with fuels, is you really have to get to large economies of scale to drive down cost and to get cost competitive. And the other challenge that I think if you're being realistic about looking at your tech is you're really never comparing greenfield versus greenfield. A lot of ideas look great on paper when you're comparing, greenfield new cement plant versus a building of a traditional cement plant. But that's actually not what you're comparing with. I mean, these companies have already built these plants, the capital's already sunk. And so you're really trying to compete with economics of somebody who's already producing and putting stuff to market. And so the thesis really at Fortera that we went down the road of was, how do we actually leverage what these big companies already do well? They understand scale. They understand driving down capital costs and operating costs. They understand operations. They understand how to put product to market. And so the approach we took with Fortera was leverage all those things that they do really well, bolt our technology on beside existing cement or lime plants. And by leveraging those things they do well, we can really then drive down costs to get to effectively this concept of green for free, where we're not reliant on a green premium or green subsidy to be able to put product to market.
Yeah, and essentially the way I always think about it is, you have the calcium oxide coming out of a cement plant. All you're doing is, instead of the CO2 escaping from the cement plant, you put it back into the calcium oxide, actually make a cementitious calcium carbonate, which means your throughput of any existing plant improves by what, 44%, something like that?
Yeah, I mean, look, it's a bit comical when we get talking about our technology. I mean, we're basically, limestone's the main feedstock at every cement plant. We're taking that limestone, we're turning it back into limestone. So we go through the kiln, make CO2 and lime, recombine it. But we go from an inert rock to a form of limestone that's actually cementitious and can be, again, used as a partial cement replacement all the way to a standalone cement. The benefit of that is it takes CO2. So in traditional cement, when you put limestone in the kiln, you lose almost half its weight, 44% of its weight to CO2 emissions. And so because we put that CO2 back into the product, it's actually 1.8 times the amount of product you get for every ton of limestone process. So you get more product, which is what helps on the economics and also what makes the CO2 story work on it all.
So you let current cement manufacturers achieve economics on day one, while capturing CO2 or not letting CO2 go out is just a nice benefit.
Yeah, it's really is turning the CO2 from a waste and an issue actually into product, and that's what drives, again, the economics to work. And at the end of the day, I think it's really in these types of industries, it's all about economics. So the economics works, and it's great that there's also a CO2 benefit.
Got it. So let's talk about de-risking. What are the key steps you took to move from lab to demo to first of a kind without over-raising too early? That's been the challenge in Cleantech 1.0. That was the challenge in Climate 2.0. And because we've been through this for 20 years, we are nervous about companies raising too much too early, become too big to fail. And sometimes that becomes a reason for failure. So how are you managing it? Why do you think you've been successful despite not raising a lot?
So, and I know this was a later question for you, but maybe to get to it now, when we talk first of a kind, I really always view it as there's two first of a kinds, right? So you go through your piloting demo work, you get that technology far enough along to go after the first effectively commercial plant. But to me, there's a first of a kind technical that you're doing, which is really what's the smallest plant size you need to build. At least this is how we viewed it. What's the smallest plant size you need to build to get past the tech de-risking, so that partners or customers will then go all the way to full commercial plants. And so that's the first of kind technical. That's the plant that we brought online last year in Northern California. And then there's first of a kind commercial, which is you're past the tech de-risking stage, but now you're really trying to figure out the financing stage, because you're kind of pre-bankability, nth plant, getting through all the risk stage of it. So those are two very different things or different first of a kinds to solve for. So for us, it was again exactly that. It's getting to the first of a kind technical. That's the smallest size to improve technical scalability. And frankly, being lean with the team to only make sure you're hiring and bringing people on as needed to get that over the line. Because I think anytime you're trying to execute on a plant, it's easy for that team to really start to grow because there's just so many things that need to get done. And so we've been fortunate to bring a team on that can wear many hats and do a lot of things as you get through that first of a kind technical.
Got it. Help me understand your financing strategy. How did you structure the financing, TopCo versus Project Co, or how do you think about it going forward? And what lessons emerged around how investors were looking at IRRs for these plans?
Yeah, so if we kind of stick with that first of a kind technical versus first of a kind commercial, on the first of a kind technical, my view's always been that you really have to do that from TopCo, because again, you're trying to get to the minimum scale to prove technical scalability. So you're really not typically focusing on, at least in the hard tech space or these high capex, low margin spaces, you're not typically getting to plants that are going to have strong enough IRRs to get traditional project finance or growth or other infrastructure type groups involved. So you really need to raise money at the TopCo to do that first of kind technical plant, which is again why you want to try and make that as small as possible to get that to get that tech de-risking done. When you get to first of a kind commercial, to me, this is where there's the biggest hole in the kind of capital stack that's out there. It's, you can do TopCo with your first of a kind technical, but first of a kind commercial, you're pre-bankability. You're not at a point from a risk profile that you're going to get in a lot of the infrastructure growth, typical people that will be there for nth plant when you achieve kind of nth plant pricing and risk. And so solving for that capital stack on that first of a kind commercial really requires bringing the right syndicate of groups together. So we've approached from the perspective of how do we get some project level finance in, so get to strong enough IRRs by again leveraging what the industry already does well and bolting onto plants, that we can get project groups that will do first of a kind project finance to the table. We've done it from bringing sub-debt groups to the table. We've done it from bringing the actual strategic partners to the table to put funding in towards it. And then we've also gone downstream to the people that are actually looking for environmental attributes as well as for green product, so that we can bring enough different groups together to help de-risk that financing.
Got it. And give us a perspective on the investor lens overall. What kind of frameworks were critical in getting to the commercial folk discussion with these investors? Obviously, it's a different kind of fundraising the frameworks you have to have, the financial model that you need to have, the bankability, the proof points you need to have, versus fundraising for Series A, Series B. And Ryan, you've been very helpful for some of our other portfolio companies and walking them through, what did you have to prepare for the rest of the portfolio companies to really think through the later stage fundraising. So help us understand, so it'll be valuable for everyone.
It's a lot, right? It's a very different mindset going from earlier stage tech and really kind of having your high level models to really getting more into the project side. And so we brought in CFO and a project finance group that really understood what it takes to get to the models and the level of detail needed to get people comfortable. And so that was a journey we had to go through. And I think it was a journey that was also especially tough in the cement space, because generally speaking, a lot of the project finance that is out there is built off of offtake agreements and them getting comfortable with cash flow based off of offtake agreements. Unfortunately, in the world of cement, and I suspect similar in the world of steel, maybe, is cement doesn't typically work on offtakes. And so that means the pool of people that were looking to fund plants, we had to get them comfortable enough with the merchant market risk around cement, with the product and interest in our product, that people would buy it, that they could get comfortable with the overall project economics and being able to move forward with it. And so that's been a long journey, and it frankly required us going all the way downstream on the market to make sure that there was pull, that make sure it was clear that there was customer interest in the product. And so it's bringing everybody together to get people comfortable it's not an easy journey.
Got it. But hiring the right team, having the right investor syndicate, and learning from other people who have done that has been super helpful, I suppose.
Oh, for sure. I mean, look, the team that we brought on, this is what they're, I mean, we have people on our team that have spent decades now specifically in project finance and also in Climatech space, right? So they understand the players are at the table and what's needed to get them comfortable with financing. Also on the investor side, I mean, in our Series C, we brought, alongside Khosla Ventures and Tomas, we brought Wallamai in, who very strong background in project finance, right? And so it's bringing people to the table that understand kind of the challenges in navigating the space, and to making sure we're getting the right advice and the right guidance to navigate it.
Got it. Helpful. Is there a slide or a framework we are planning to share, Ryan, if available? Or that's okay. I can go.
Yeah, unfortunately, just I don't have. I know we've talked about it, but it was so specific to Fortera that I figured I'd leave it off. Yeah.
That's okay. Yeah. So let me jump to the economics piece, like the cost question we had with Jennifer. There are these 3 or 4 pillars that we consistently care about. Cement is all about economics. Nobody really cares what's the gizmo there. It's at the end of the day, it's a commodity product. They want to meet the economics. How did customer feedback shape your product and pitch?
I would say this is not even just specific to us, but I think in the space, I mean, that's another one of our core, it's a core value for the company, is you have to think customer. I have fooled myself many times over the years in developing technology that, we have a differentiated product, differentiated tech. That's what people would go after. And so we have quite a few people within the company that are from the cement world, and also at the board level from the cement world. And we spent a lot of time with the big cement companies, really trying to understand what would actually drive them to adopt a new technology, to be a first mover. Because that's one of the other challenges really in the space is, as I always say, everyone wants to be first to be second, right? Because these first plants cost more, they're less efficient. You have all the challenges. You haven't gone through that de-risking in the same way. And so it really is about listening to the customer and what it is you need to solve for them to actually be an early adopter. And I think in the cement space, some of the lessons learned is it's not about actually having necessarily a better product, because you don't want to have to retrain the whole space. They want to make sure it's a product that, to the ready mix level and then to the end contractor level, anybody can pick it up, use it, don't have to be retrained, and it's gonna kind of plug and play with the existing landscape. And so understanding that's really what was being looked for on the product side. And then on the economic side, it was really about making sure we could produce a product that wasn't reliant on a green premium or incentives to actually be cost competitive. And that doesn't mean that we're not looking to take advantage of those types of incentives and environmental attributes early on. That's I think all technologies and Climatech are going to need to look for ways to take advantage of those things to make the economics work for early plants. But they needed to see a pathway that without that, these will be economic. So when they're making a decision on a plant, these are not a few year decisions where, and a lot of the regulations in their place or incentives are time bound. These are decisions that are for many decades. They want this plant to be running, and so they want to know that it's going to stand alone well after incentives are no longer in place.
Got it. Capital. Let's talk about capital availability today. Give us a perspective on how much capital is available globally versus US for your industry, and how do these international funding opportunities and incentives come across as you scale?
Like, Rajesh, I feel like that's the question I should be asking you more than you should be asking me. I think, look, a lot has changed over the last, at least within the U.S. landscape. Things have changed on the Climatech side. I think all of us in Climatech right now are really trying to understand where the existing capital is, where incentives are going forward. So ourselves, as well as I'm sure anybody in the space, is now looking globally in terms of where there's investor pools that are right, but also where there are partners that want to adopt new tech and bring new tech to market. And so, for us, we look at it from the perspective of the cement industry in some of the developed areas is pretty well established. These are big players, and so they're going to have very different things that will drive them to put a new technology in place versus some of the areas that are really developing and actually building cement plants and greenfield plants. And so I think we've really tried to look at it from where are the different opportunities, what are we solving for that's different with those different areas, how do we get people both from a partnership perspective and from a financing perspective interested. And that's a journey we're still on. But I think it's for everyone that's in this space, is looking now broadly, globally at all the opportunities.
Yeah, and maybe if I try to answer that question for broadly sectors, I think the funding availability is a function of sector. In the US, for example, we certainly do see a lot of funding interest in things like nuclear, geothermal, and a few other areas, because if you're building these data centers, you're creating cities of the size of New York City probably every few months, and you cannot build your way to energy with just coal plants and just natural gas turbines. So there is tremendous interest for the only other 24/7 baseload power that's available, which is nuclear. And we are big fans of fusion. We are early investors in Commonwealth Fusion as well as Rialta Fusion. We think that's the right approach to address the fusion needs. But geothermal is certainly happening much faster. We have a company called Mazama. In fact, Sriram was supposed to be in this. He had an urgent one, so Lauren kindly stepped in. So Mazama is another one in terms of geothermal. So those are getting a lot of interest. And Ryan, to your point, even the data center guys are looking for construction, and that's where I think Microsoft invested in Fortera for what you guys are doing.
Yeah, I mean, it's again, I think for all these, as you look to bring a new technology to market, is looking for where you have specific customer needs or wins that you can leverage. And I think with the data center side, I mean, you correctly pointed out on the energy, I think it's a very different landscape now for energy given the needs on data centers. But at the same time, most of the hyperscalers have made strong commitments towards CO2, and so since they made those strong commitments, there's obviously a big energy draw now with all the data centers, but they're also building a lot more buildings, and that has a implication from the cement concrete usage. And so we are seeing that interest coming in from the data center side. We are lucky to have now Microsoft part of our cap table as an investor in the company, really from that viewpoint of both from a product and environmental attribute purchasing for cement. So again, I think as for the entrepreneurs on the call, it's really always looking about, if you look at the full ecosystem, who are the people that really can benefit from your technology, and making sure you're bringing in all of those different groups to help, again, round out that capital stack because again, first of a kind commercial, so hard to get to on funding. It's really bringing every player in that you can.
Yeah. And strategic capital is the other one. If there are cement plants in India or Europe, any of them could be potential partners, potential investors. So that's something as a founder, you always keep your eyes on. Where else could this be coming from in terms of building the facility, and what are the creative structures could be helpful, whether you raise the money at the top co or the project co. All those are, different perspectives to think through raising the same amount of dollars.
Absolutely. And that's what, again, in the terms of the think customer, everybody has different things that they're solving for. So make sure you really are paying attention to what are their pain points, and how can you help solve that to get them involved.
Great. I'll jump to Lauren now, talking about the steel opportunity. Lauren, glad to have you here. We led your pre-seed and the seed round, or seed and Series A. I always get these terminologies confused, but glad to have led the last two rounds. I would certainly say you've been one of the fastest in the climate journey that I have seen in terms of going from a seed to ready to be a first of a kind plant. It was impressive to watch your journey. Let's talk about the capital discipline you've had. You raised modestly while some of your peers raised 10x more, and they're not even close to where you are. How did you stay focused on de-risking the core science efficiently? And maybe in that process, tell us a little bit about your technology.
Yep, great. Thank you, Rajesh. So Hertha Metals has developed a process that is firstly pyrometallurgical. What does that mean? It means we do things at high temperature and molten phase, and that's similar to how we've been making steel since 1850. It's through pyrometallurgy. So firstly, that's an important note. Steel is a conservative industry similar to cement, right? It's very difficult to get them to adopt new technologies. And so by design, we wanted to parallel as much of our technology as to what they're used to. So it's a pyrometallurgical approach that can take any grade of iron ore in any format, meaning also fines, and convert that in a single step to pure molten steel with, again, reduced cost and emissions. Our process today runs off of natural gas and a bit of electricity with the ability to switch to clean hydrogen without necessary hardware changes once those costs get to the point needed for the steel industry. So when founding the company, which was back in 2022, before we even raised private capital, we at that time had a grant. I went out and spoke to industry and spoke to the incumbents in the steel industry and asked them, at what scale do you need to see the technology for you to believe in the commercial viability and scalability? It's not at what scale would the economics hit it. It's at what's the minimum scale for you to even believe what I'm saying. And over again, they said 1 ton per day. And so what we did at Hertha Metals is say, how can we get to 1 ton per day as quickly as possible and as capital efficiently as possible? Why does capital efficiency matter? The steel industry needs billions of tons per year, right? So you're at 1 ton per day. You still need to get to at least 1,600 tons per day to have any appreciable effect on the industry. And so you look from day one, what are those fundraising rounds I need? And it's very important to make sure that you're not burning through all that capital on your small plant when you have additional plants to get to. And so we did that with our 1 ton per day pilot, really leveraging parallel engineering. So meaning we would be testing in the R&D lab as we're designing the pilot plant. We would be actually building the pilot plant as we're moving on to our next scale in the R&D lab, et cetera. And that enabled us to get there quickly. So in less than 3 years, 0 to 1 ton per day. And the capital efficiency came into play with understanding who are the right equipment providers, first of all, and partners at this scale. Do you need to work with the big EPC names for your 1 ton per day pilot, or can that wait? And which partners see the long-term vision versus just this one purchase order?
Got it. And your approach can use natural gas or hydrogen as the input. You don't need to change anything in the hardware. Now, I know when you started the company, you started with hydrogen, but from a market perspective, you validated natural gas. You're going with natural gas first and then hydrogen. Help us understand, how did you move from one to another? Does it matter? What's your long-term goal?
Yep. So when we founded the company, it was based on hydrogen, and we also demonstrated our use of hydrogen as a chemical reductant in our 1 ton per day plant. But we very quickly saw that the cost of clean hydrogen, whether it's through electrolysis or any other means, is not going to be at the point it needs to be for you to come out with a steel product that's cheaper than today, right? So before, with the political climate and policies available, just hitting cost parity used to be enough, right? You're greener, but you're cost parity. Today, what we see, and really starting from Q4 of last year, you have to approach the market with something that has a massive cost differential, so a negative premium. And so we switched to natural gas as we saw, actually, we can both reduce emissions and cost, right? Using natural gas today and Texas carbon intensity, we reduce emissions by 50% and the cost of production by more than 25%, which is huge in a commodity market. So what's natural gas though? Hydrogen and carbon, right? CH4. And so at the end of the day, in our process, the hydrogen is nonetheless doing a majority of the reaction. And so we haven't switched from using hydrogen as a reductant. We've just moved towards what is the carrier, what is the hydrogen supplier, and that is natural gas.
Yeah, no, that's been very, very helpful in terms of gaining the momentum and not waiting for the hydrogen prices to go down.
And you decouple risks, right? I no longer have my technical risk alongside the commercial risk of hydrogen having to get to the right price point for us to be cheaper cost parity.
Yeah. Tell us a little bit about the technical de-risking. How did you validate and iterate cheaply before going for a first of a kind build?
Yes. So Khosla Ventures, partly you, Rajesh, helped us really front load technical de-risking. You helped us really understand the value of de-risking as much as possible, as soon as possible. And so what that looked like was, first of all, that this 1 ton per day pilot plant is integrated in the sense from continuous ore feeding, continuous power, continuous gas to semi-continuous tapping out your product, the same way you would operate the commercial mill. But there are certain things that you can't necessarily de-risk at that scale of a furnace that we have to de-risk at our first of a kind. And so what we did was think about what other really quick, dirty, cheap setups can we create to de-risk some of those things. So when you think about what that means, steel is a high temperature process, right? Are there room temperature models you can do? Can you build a water tank and simulate what's going to happen at that very large furnace scale? And by doing that, we've been able to de-risk almost every single aspect of the invention, such that moving from where we are today to our next first of a kind plant, you're simply continuing to increase furnace diameter. There's nothing else changing around the system. And we find that really important. So also touching on this first of a kind, what does that mean? Ryan had touched on there's a technical first of a kind and a commercial first of a kind. We've been working to make what could be considered a next technical first of kind into also a commercial one. And what does that mean? Steel needs economies of scale, right? So our next plant will be a 9,000 ton per year plant. Steel mills produce at 500,000 to 2 million tons per year. So still too small to compete on a commodity basis. So what did we say? What product could we make within this same plant that does have that higher price point such that we can be profitable? It's not commodity steel, and that's okay, but it enables you to develop this commercial first of a kind for this first market as you scale your steel story.
Helpful. Maybe last one or two questions for you, and then we'll jump to the Q&A. A lot of good questions here. What does your first of a kind outlook look like? What does your first plant roadmap look like? Partners, funding structure, technical milestones. Give us a quick 2 minutes. So other entrepreneurs thinking in your shoes at this point, thinking of the first of a kind plant, have a view on how they should think about their partnerships, funding structures, and so on.
Yep. Partnerships, customers are your partners. Your customers are your partners, especially for first of a kind. They're taking risk with you. And so we've looked for partners both downstream and upstream for this first of a kind, meaning mining companies. So we've partnered with domestic mining companies so that we have a fully domestic supply chain at this plant. And then funding structure, we are leveraging Topco investment with equipment financing for this next plant. And this tees up our ability to unlock project finance in the subsequent full-scale commercial. So technical milestones, as you move along this roadmap, you have to think about what are the scaling factors. What's truly scaling? It's not necessarily volume. In our case, it's furnace diameter. To unlock project finance, it's really tricky if you go beyond a 3x scaling factor. And so from our current plant to the next one, we have a 4x factor. And from the next plant to our full-scale commercial, it's a 3x. So designed to enable this unlock at that 500,000 ton per year scale. Technical milestones next. So we've already demonstrated the technology works. We have great product consistency. Next is plant uptime. Very important to demonstrate especially in a commodity market, your plant can stay on at least 85% plant utilization factor. Whereas at the pilot plant level, you want to design it to be flexible. You, as Jennifer said, you need that really fancy rotary pump. For our pilot plant, we didn't. We can run 6-week campaigns. That's all we need on off. And so this next plan is designed to just run straight all year long.
Great. I'll jump to the some quick questions here from the audience. I think there's one question for you, Ryan. In terms of your technical folk and commercial folk, what are the best hires you need to make when aiming for a technical first of a kind and a commercial first of a kind?
Yeah, I mean, it's probably a longer question in terms of looking across company, but I say the fundamental things that we did going from technical first of kind to commercial first of kind is really bringing in people from the project finance side. So really understanding how to build out the capital stack for these commercial projects, as well as bringing in really the project management expertise. So, as you go up in scale, holding budgets and schedules and really making sure that you're getting that design done right. So we built out a whole project management office and bringing in project engineers, project management professionals to do that. So I say that's probably the biggest shift in hiring that we did from technical to commercial. But obviously, across the company, as you go towards commercial too, there's all aspects of the company, from everything from how you're going to market, your go-to-market strategy with your product people, your marketing branding, all that stuff had to really be ramped up to bring the right people in for the commercial side piece.
And there was a relevant question any of you could answer. How do you think about fractional hires for some of these stages? Has it worked out? Is it meaningful at some point? Does it lose value at some point? Give us some sense. This is something I struggle with for some other companies as well, to bring in some top talent as a fractional, but would love to get your opinions. Ryan, you want to go?
Yeah, sure. I mean, so I've always viewed it as, look, if it's a short-lived role that you need really some level of expertise to come in and help you with, then for sure you can go that route. But if it's something core to the company, I've always viewed it as really make sure that that's a skill set that you then build and have within the company, going forward. And so we do rely on both. We've brought a lot of consultants and other things in over time, but it's generally more not for what's core to the company, but more to give either advice on a specific area or something that's kind of short-lived that we really need expertise for a short amount of time to solve for.
Got it. Did you take topco level debt because it was the only debt option available?
This
For
me?
you?
Oh, sure. Yeah. So I think the hard part is when you start building out commercial projects, and look, we have our certain views on this. I think everyone has gone about this different ways. I'm be interesting, Jennifer, to know how you funded all the projects. But I'd say those first projects, I think there's a point at which the IRRs are good enough at these projects that things should be able to be funded at the project level and bring project finance and debt and everything in at the project level. But in the early projects, wanting to see that Topco has some skin in the game, and because of the risk profile, I think a lot of it has to be done at the Topco level, which is where we've approached it from.
I mean, at the end of the day, to determine if it's Topco or Project Co, you have to formulate your financial model. You have to understand your IRRs. You have to understand what your debt coverage ratio will be. There's very equation-based things to some of this that question. And I would piggyback off of what Ryan said of Topco has to have some skin in the game. And so I think it depends on what are the economics of your plant, what do your partners want to see as well, and then what can you merely access?
Got it.
Can I jump in for a second?
Yeah, I was
Because
going to come to you, Jennifer.
I did the first of a kind a little bit different than everybody here, because we used a licensing model. And in a licensing model, you leave a lot of money on the table, but you are not financing that first of a kind. So we were able to actually build multiple first of a kinds. It's not really well known in the industry because we just use LanzaTech technology, but the plants in in China, steel and ferroalloy tend to have 40 to 60% carbon monoxide, the active ingredient. The plant in Belgium has 20% carbon monoxide. The plant in India is actually a CO2 plus hydrogen plant with some CO. So technically, every single one of these plants is a first of a kind for us. And so to demonstrate the breadth and the wealth of the platform, what we have actually done is leverage the licensing model where our partner has put in the CapEx. So we haven't taken debt, we haven't done equity for building the plants, we've developed technology instead. We're evolving from that model, but that doesn't change the fact that that's how we got here.
And that, to your point, Jennifer, has enabled you to do the cost curve reduction. Now you're not building just ethanol, you can go all the way to the SAF production as well. And maybe talk a little bit about that LanzaJet financing that you did, the creative way of spinning out to build the alcohol to jet plant.
Yeah, so that's a great question. What we did, we developed the technology ethanol to SAF. The company is biological. The ethanol to SAF is thermocatalytic. They don't really fit together when you start to scale and you want to raise capital for it. The other thing is we wanted to build as a commercial demo. We wanted to go from the 10,000 gallon a year size, pilot size, to 10 million gallons. The industry doesn't have time to just wait. And so we wanted to go to that next step. And to do that, we brought in other investors. We brought in Shell, IAG, Suncor, and Mitsui. But the reason this is relevant is because we said, what do we value our technology that we've developed? And we said, we will get enough shares as the equivalent of 4 licenses. But we didn't get all 4 licenses at the beginning. The first license allowed us to be on an equal footing with the other investors, all of us having about 25% of the company. So we risk shared. And then what we did is say, okay, but if the market is interested in the tech, then you owe us more shares. And that's exactly what's happened. They owe us an additional 3 shares. One's already been gotten, and the other 2 are in the pipeline. So it's a different way of creating a community to build the first of a kind that has been really helpful for the company.
Very helpful color. Question on the payback and IRR for heavy infrastructure, hardware, FOAK tech. What do investors need to get in return? Do you still see a 5 to 7 year 10x payback? What numbers do you guys hear? What IRRs? Pick any metric. Jennifer, you could go. Then I'll ask Ryan and hear from Laureen what she's hearing from others.
Yeah, once we did the first of a kind, we were able to access infrastructure dollars. And so that's what we're doing with Brookfield. And their expectation is really to be in the 13% IRR range. So, and the way we solve for 13% IRR is we asked ourselves the question, at what price do we have to sell the ethanol or the SAF to get that 13% IRR? And that's how we validate whether a project should be put in the pipeline.
Got it. Ryan, you want to go next?
Yeah, I mean, I think once you get past, the first of a kind, you're getting more towards end plant pricing and you're drawing on that capital. I think that's exactly the same range as we've heard. For first of a kind commercial, we definitely have had lots of proposals and discussions where I think people are pushing more towards the high teens, so 18% for really first of a kind commercial. But it's always going to be in, I think somewhere in that range at a minimum. And that's really at a minimum because they have to get comfortable with the tech and the scale up and the risk, and that they're going to need that hurdle.
Got it. Yeah. Laureen, what are you hearing from investor expectations?
Similarly, 18%. And for reference, we're currently fundraising. And so we're having these conversations today around 18% with the understanding that if you look at the average IRR of a steel mill, it's anywhere from 7% to maybe 15%. And so you ask, why does it need to be so much higher? And that's only true for the first of a kind, maybe even the second one, because they're taking on that additional technical risk. So I think it makes sense.
Okay, helpful. I think we'll wrap up shortly and would love to get any one final word of wisdom from each one of you. But if I look at the kind of things that you laid out and marked, I think the thing that stands out was integration into existing facilities is a big deal. We even think about it for even our nuclear fusion company, CFS, when we invested in CFS back in 2018, we looked at it as how do you integrate a fusion as a boiler equivalent in a coal facility. Like you cannot be as far off from a technology perspective between a coal plant and a fusion plant. But if you can integrate, if you really look at a fusion technology as a boiler and then integrate into a coal plant, you're keeping the rest of the infrastructure the same way. All the interconnection, the rest of the balance of plant, all of that stuff. And that's the extreme way of looking at it for two different technologies. But that's extremely valuable because that's what, Ryan, you're doing. Lorraine, you are looking at it as you think about electrical steel and other things. Jennifer, that's clearly what you have done. Because if I look at LanzaTech, while others are trying to come up with expensive CO2 that they have to get, expensive hydrogen that they have to get from electrolysis to make e-fuels, the math is significantly off. Whereas you are getting free CO2 by integrating into existing steel mills, whether it's CO2 or carbon dioxide or carbon monoxide. And then you're using all the infrastructure that's available there to produce the ethanol to make the SAF. And Ryan, that's true for you as well. So that's a consistent theme we have seen with some of our winning companies. And sequencing the right offtake agreements at the right time has become a critical one. I think some of you had the third element I marked was kind of option value. As you develop the technology, Lorraine, for you, it was natural gas and hydrogen provides you a good option value. You can call it flex fuel or option value. For Jennifer, it was for LanzaTech, it was looking at multiple products, and you have zoned it in on sustainable aviation fuels and marine fuels as super compelling, very large opportunities, while you also had parallel efforts on carbon to textiles and a whole bunch of other areas. So having that option value for an early stage of a company, but narrowing it down where you focus becomes a critical one. You could call it as option value or pivots or whatever it is, but putting in small dollars to get to that point becomes critical. The other consistent theme I've seen with all of you is that techno-economics. You started with, from day one, I distinctly remember, Lorraine, even at the pre-seed seed stage, you really had a good techno-economic model to convince us, why this is the lowest cost way to produce steel. You didn't come and say, I have a fancy electrochemistry that will change the world. To me, something like that is taking a cannon and shooting a housefly. That doesn't work in climate. You really need to be cost effective. And that's been consistent with all of you. I think the other element I noticed was each one of you were building a company to value, not to valuation. And that discipline cascades in terms of who you hire, what you de-risk versus let's take as much money as available before the tourist investors go away. That drives a different mentality, different principle in terms of building a company to a real value. And eventually it just pays off. So high level, my takeaways, but any parting thought, Jennifer, from you? Any words of wisdom you want to share with the community?
Don't give up. Focus on the mission and how to get there, and don't let any doors close in front of you.
That's super important. I met LanzaTech. The very first time I met LanzaTech when I was a different fund was in 2008. And here you are, churning out products and factories. Ryan, anything from you?
I mean, honestly, I was going to say really the same thing as Jennifer. I think that, especially for the entrepreneurs on the call, look, scaling, especially in hard tech, is incredibly hard. And frankly, each scale you go up gets that much harder to figure out how you're going to navigate and get this over the line. And so, I think you just have to be really mission centric. For us, I know we have a product that fundamentally will change the cement space. Our pure product can solve for sustainability, but also has benefits in terms of the product quality. And so as you have your wins and losses, it's just always kind of recentering around the mission and why you're doing it. Because I know it's inevitability. It just means we're going to have a fun, but very hard road to get there.
Lorraine?
It's funny that my desktop says never give up, never get discouraged. And my husband, who's an entrepreneur, has a necklace that says that too, because it's just so important to keep that in mind. There are going to be a lot of ups and downs. We did not choose an easy path in the types of companies that we've started and what you all are considering to start. There are a lot more easier things we could have done in our lives, but it's worth it. And I would say to think of this as a career. Think of this company you're starting as a career and not a 3-year sprint where you should just get the valuation as high as possible and then exit. Because at the end of the day, those companies don't make it, right? The ones that make it are those that did have the discipline and focus on the true business case from day one and as it continued.
Great feedback. Thanks, everyone. It's a pleasure having you all here, giving words of wisdom. I continue to learn every day from you all. So thank you. Thanks for everyone who joined the session. There was a question on sharing emails. I'll figure out with the organizers as to how to share the emails of the founders. Many of them wanted to connect with each of you to invite to some events, or they have a low-cost hydrogen approach or other ideas that they want to work with you on and get to learn more on the FOAK. We'll figure out what's the best way to connect with you with some of the folks.
Amazing.
Thank you.
Thank you.